Hello everyone, this is Philippe Villard, the head of the Economic Policy Unit at ACI World, notably in charge of slot policy. Thank you very much for joining this session of the Global Outlook of Airport Capital Expenditure presentation that we are giving at the Slot Conference. And we hope that you will find it interesting even in this hybrid format. My colleague Franco and I remain at your disposal if you wish to further discuss the topic. In this session, we will present insights on the required investments for existing and new airports. This is important in terms of slot allocation because failing to address airport capital expenditure needs in the future means that there will be not enough capacity to accommodate demand. We will also cover the socio-economic implication of failing short of capital investments to adequately address airport capacity constraints. Just a word to say that what will be presented was developed in cooperation with Oxford Economics and Taylor Airy, and with the financial contribution of Hamad International Airport. If you're interested into the data, or if you want to have more granular analysis, you can find the full report and its dataset on the ACI World publication website. Let me start with the global passenger traffic forecast. The impact of the global coronavirus pandemic and the subsequent travel restrictions are well known. And while reductions in passenger traffic have occurred as a result of past shocks, the prolonged shutdown of air traffic by the end of March 2020 and the slow re-emergence of travel are unprecedented and have devastated travel. That said, it's important to note that past aviation downturns caused by external shocks have always reversed, returning to trend levels of growth after some time. However, in this case, the global coronavirus pandemic is the largest shock to impact the modern aviation industry by a significant margin, and consequently, it is likely to take longer to return to trend growth rates than previous shocks. But despite that, global passenger volume are forecasted to increase rapidly with little residual impact after 2025. Understanding the history and the current state of airport capital investments provides insightful context for our upcoming discussions on future capex needs. Globally, airports, whether public or private, invest an average of $7.8 per passenger. And investments level vary by region. Developed countries and regions where capital costs can run relatively high tend to spend a higher proportion of capex. And rapidly developing countries and regions, for instance, the Middle East, China, India, also generally show higher level of capex per passenger. Prior to the coronavirus pandemic, many of the countries with higher airport capex ranked among those with the fastest projected passenger growth globally. And this rapid growth necessitates infrastructure and air transport capacity expansion, and hence the often higher capex per passenger level. And note that just as investment volumes vary, the type of capex investment also varies by regions. And in mature air transport markets, capex tend to focus on retrofitting, maintenance, and replacement of aging and time-expired assets. In these mature markets, much of the expenditures reflect land use constraint. Simply put, there is little room to build new structure, expand runways, etc. Just a word to mention that the countries with the largest overall annual historical capex spending between 2015 and 2019 were China, the US, the UAE, or Germany. The reason for high capex spending varies by market. Capital investments in the US, for instance, largely reflect the higher costs of expansion and retrofitting aging airport infrastructure while still maintaining passenger services. China and the UAE, on the other hand, captured the robust expansion of airport infrastructure, including new airports, terminals, runway, passenger amenities, etc. So this was to set the scene, but now let's delve into the capex forecast to develop airports. The long-run trajectory of capex needed to meet air passenger growth projection illustrates significant growing investments, which is heavily skewed towards Asia-Pacific. By 2040, ACI's forecast suggests that approximately $170 billion will be invested in airport capital projects in that year alone. Cumulatively, the 20-year period leading to 2040 indicates about $2.4 trillion in airport capital investments. Let's have a look at the short run, medium run, and long run. In the short run, 21-22, global capex outlook will see a significant investment drop compared to previous year. One key exception appears in North America, and specifically in the US, where the government stimulus package has largely preserved ongoing airport capex projects. In the medium run to 2025, our forecast suggests rebound in airport capital investment. The increased demand for more airport capacity begins to resemble pre-coronavirus levels as passenger confidence resumes, and the medium capex growth is forecasted at approximately 5.5% per annum. In the long run, 2026 to 2040, capex forecasts assume a return to long-run trends and growth in passenger demand and social and economic growth. This requires increasing amounts of capital investment to meet air traffic capacity needs. The nominal amount of capital expenditures continues to increase as the capital stock of airport infrastructure accumulates, that is, new airports built and existing airports expanded. This, therefore, requires further investments to maintain a growing number of facilities, and long-run capex forecasts indicate a 4% per annum growth, totaling $2 trillion between 2026 and 2040. Please note that the outlook for capex to meet short, medium, and long-term passenger demand does not account for the additional amount of investments needed to achieve sustainability target of carbon neutrality and net zero carbon emission by 2050. And I'll conclude my presentation on these elements specifically. Let's continue to delve into the ACI forecast for airports' capex needs. Short, medium, and long-term forecasts account for both brownfield and greenfield projects. We estimate that 150 new greenfield airports will be constructed by 2040. And capital expenditure associated with these greenfield airport projects will exceed $730 billion between 2021 and 2040. Asia Pacific, and specifically led by China and India, comprises the majority of forecast greenfield capex. On the other hand, brownfield investments dominate the capex outlook on a proportional basis. Expanding, upgrading, and maintaining aging airport infrastructure will require significant investment. And between 2021 and 2040, planned capex forecasts that we estimate are at about $1.7 trillion cumulatively in brownfield projects. Let's apply this capex allocation to estimate future capex spent by type. And note that this is done only for brownfield investments. Inclusive of only brownfield capex, terminal buildings and aircraft movement areas comprise approximately 72% of airport capex. This represents about $60 billion in annual investments over the next 20-year period. Following the trajectory of overall capex investment, this value is forecast to grow considerably over time from $33 billion in 2021 to more than $84 billion in 2040. I would like to spend a bit of time on these slides on regional capex forecasts. From 2021 to 2040, we forecast that approximately $2.4 trillion in airport total capital investments will be needed to address the long-term trend in passenger demand. So $2.4 trillion. Asia-Pac comprises about 1.3 trillion of needed capex. This reflects the region's rapid passenger growth and subsequent demand to develop new greenfield airports, as well as to modernize and expand existing airport infrastructure. An estimated $580 billion in new greenfield airport construction will be needed to support the capacity needs of passenger growth across the regions. And this is about 44% of the regional airport capex that will be needed for greenfield airports. Europe will need $430 billion in capex, and this represents about 18% of the global capex total. More than half of this investment is expected in terminals to maintain and retrofit the region's aging infrastructure, as well as address the capacity constraints that are well known in the face of growing passenger demand. Nearly 1/4 of the projected needed investment will focus on aircraft movement, and projections indicate that new greenfield projects, especially in Eastern Europe, amounts to about $77 billion. North America's projected 400 billion needs in capex represent about 17% of the global total. High costs are associated with maintaining the region's aging infrastructure, coupled with the demand to expand existing airport capacity through retrofitting or constructing new terminals and improving aircraft movement areas. Note that our projections suggest that new greenfield airports are very minimal or unlikely, as airports have strong geographic coverage in the region. Just a quick word on the Middle East. Capex needs amount to about 150 billion between 2021 and 2040. Near-term greenfield airport projects are expected to comprise about 56% of total near-term regional airport capex, though that share will gradually decrease over the long run as the region meets long-run air passenger capacity needs. A word on Latin America, Caribbean. Its capex need represents an investment of about $94 billion. The strong passenger demand growth in the region, compared to the limited airport availability and capacity, means that growing shares of the airport investment will need to be greenfield. An estimated 41 billion will be needed in new greenfield development, about 45% of total investments over the 20-year period. Last but not least, Africa's forecast 2021-2040 capex needs exceed 32 billion. The region is still emerging as aviation markets are concerned, but the pace of needed new greenfield airport investments represent nearly 40% of the projected total capex need, about 30 billion. Investment demand for expansion of existing brownfield airport infrastructure within the region is largely centered on aircraft movement and terminal buildings. So that was for a global and regional overview of a capex need of the airport industry. And now let's have a look at the impact of the infrastructure gap, or the impact of not realizing these airport capital expenditure. Failure to address capacity needs to realize projected 2040 demand will have real socio-economic consequences. So I'm not going to talk about the slot issue and the risk of increasing congestion and having to impose administrative allocation of airport slots, as this is something that we discussed here at the slot conference. But let me mention that for every 1 million foregone passengers due to airport capacity constraints in 2040, the global air transport industry would support 10,500 fewer jobs and 346 million less in GDP. Estimates of potential foregone passengers due to unmitigated capacity constraints through airport capital investments suggest that up to 5.1 billion passengers may not be realized by 2040. Many global airports will, after the recovery period, operate at or beyond current capacity, and this represents several losses. Specific issues include reduction in airline competition and higher price to consumer and passengers. A word of conclusion on decarbonization strategy. The airport industry is committed to ambitious decarbonization goals. The pathway to achieving net zero emission will potentially require additional investments by airports above and beyond carbon neutrality to reduce energy consumption and convert to zero carbon emission sources. The path airports take to achieve net zero will be highly dependent on location-specific factors. Pathways may include investment in energy-efficient infrastructure, low-emission or electric vehicles and equipment, construction of renewable energy facilities, etc. Also, new technology in aircraft design and material used to boost fuel efficiency will likely require additional airside capex for airports. Additional capex, such as gate size and configuration, could be needed to accommodate new aircraft with designs that may look very different from the jetliners currently in service. Whether dealing with short, medium, or long-range aircraft, or with sustainable alternative fuel, electric, or hydrogen propulsion, airports will need to further invest in refueling and recharging infrastructure and supply chains. The timing for the infrastructure investment remains somehow speculative. It is recognized that airport decarbonization is only addressing a small part of aviation's climate challenge, and that in the short to medium term, air traffic growth increases CO2 emission from aircraft operations. Let me conclude this session by mentioning that the airport industry financial shortfall currently poses challenges to short-term plans to modernize infrastructure towards sustainability and resiliency. The need for increased airport capital investment is an economic, social, and environmental imperative. The global COVID-19 induced economic recession has decimated airport revenues in the short run, adding new layers of challenges to meeting long-term capacity. Moreover, airports' commitment to reducing carbon emissions means additional green capital financing will be needed. Following the COVID-19 crisis, investments in infrastructure will be needed more than ever to accelerate the recovery and stimulate job creation. Governments have a key role to play to support this recovery and to mitigate the risk of falling short of certain goals linked to airports and aviation. So thank you once again for your attention. I hope you find this presentation informative. And once again, my colleague Franco and I remain at your disposal if you have any questions you would like to address. Thank you very much.